Okay, Anthony, welcome. Let me steal the screen back. So what we are doing, has my screen started sharing? Yes, it has. So what Anthony and I discussed about a month ago, just 6 weeks ago, was we did that market review in February, and where him and Garth spent, the best part of an hour discussing what's happening in the markets, etc. And what Anthony and I discussed is that what they're doing for their family office partners and their clients is ultimately doing a review of what's happening in the market, what are the important things to know about, etc. And I think from Anthony's perspective, what we wanted to do today was, I call it kind of a TED talk, but what's happening in the market, what do we need to know about, and just roughly taking the last month into account. So without further ado, Anthony, I want to kind of hand to you, and we can take it from there. And I know a number of people have asked me to record, so I am recording.
Excellent. Thank you, Scott. How's it, everyone? Good to see you. Some familiar faces on the call. Without further ado, I'm gonna share my screen. It just makes it easier. I know we're going to do a bit of a recap on markets, just see what happened over March. More importantly, Q3, as we've come to the end of that. So I think it's important to kind of show these things with financial markets. Obviously, graphs and things like that are a lot more impactful, given that you can really see what's going on. So I'm going to start. I'm assuming you guys can see my screen. Very basic slides. I'm going to just start with some of the kind of key indices, some of the big developed market stuff, and just kind of see what happened throughout March. As you can see on this slide, we've got the S&P 500 that finished up 3.7%. The DAX, which is Germany, up 1.7%. The FTSE 100, which is the UK market, that was down 2.5%. The Nasdaq, an absolute cracker of a month, up 9.5%, carrying through a lot of momentum from January and February. I'll touch on that shortly. The Hang Seng, which is China, up 3.5%, and MSCI World, which is really a developed market kind of proxy or benchmark for all the developed market countries, also up 3.3%. Now, it's important to note that these are all in their base currencies, meaning that the DAX, for argument's sake, will be in euros, the FTSE will be in GBP and pounds. But I think some key takeaways, just firstly from this graph, is you'll see quite a bit of volatility and downward pressure, kind of the middle or the second quarter, should I say, of the month. You'll see there a lot of those indices started to fall down quite aggressively, and they picked up towards the end of the month. Now, I'm going to get onto what caused a lot of that volatility, but that was primarily driven by the mini banking crisis we saw throughout the month in the US. So quite a few valuable takeaways from what happened there, and I'll touch on that, and I'll also touch on the Credit Suisse failure in Europe, in Switzerland more specifically. So as I said, these are in base currency. If I convert this to US dollars, which is an easily understandable benchmark, or again a proxy that I'm sure most of you will understand, you see the picture changes slightly, and you'll notice that some of the European indices and the GBP indices, they strengthen quite significantly, and really that's on the back of some dollar weakness. So those are important to take into account when looking at these things, is what currency are you viewing it in and why. So with that being said, again, I said I would touch on the Nasdaq in a bit more detail. So a lot of that was primarily driven by your FANGs, which is an acronym for Facebook, Apple, Amazon, Netflix, Google. They've had an incredibly strong year to date. And it's good to see. Keep in mind that a lot of those names bore the brunt of 2022. So they were kind of last year's losers, this year's winners. But it's an important thing, because we tend to see that quite often, where last year's losers are typically the following year's winners. And that really just talks to one's positioning and their diversification within their portfolio. So you don't want to be overly exposed to one sector or style or asset class, because the following year, if you've had a bad year, typically those things can bounce back quite aggressively. And we're seeing that play out in the NASDAQ. And just for some more perspective, on a quarterly basis or a year to end of March basis, that NASDAQ is up over 20%. So you're seeing some really good rebound there, and some risk on appetite starting to wash through into that index. The last slide I'm gonna touch on is just asset class returns again. This is a slide that I'm sure a few of you are familiar with. It's a slide that we use fairly often when we're talking and when we're presenting, and it really gives you a holistic view over a longer term time period of what these different asset classes or different styles have achieved. So again, just focusing on the growth component, you'll see in 2022, right at the bottom at negative 29.1, and first quarter 23, it's the leader up 15.2%. So it's obviously coming off a very low base. But you'll recall a few weeks ago or months ago, we were eyeing that sector as one that was quite attractive, given the selling pressure that it had during 2022. And I mean, you can draw the conclusion to a few of those. You'll see DM equities also up quite nicely, small caps. They've been fairly volatile this year, but also staging a decent recovery and so on. So just important to have that kind of cognizance around the different asset classes and how the roles that they play within one's portfolio. All right, so we spoke about the volatility. We spoke about the mini banking crisis in the US. Just to dive into a bit more detail on that, what we saw there was a bank, Silicon Valley Bank, a regional bank in the US. They collapsed as a result of taking aggressive risks on their balance sheet. So they were holding long-term government treasuries, and it's a common practice for most of the banks, except when your allocation to that asset class gets a bit too high and you're unable to manage the change in interest rate cycle, and you end up getting hurt by the losses there. So that's what's happened with SVB. That caused the bank run. Guys were trying to withdraw their money, and that contagion did spread a bit, but it was fairly contained. I think in the middle of the month, when it was all happening, it was quite a scary place. There were a lot of rumors going around a total kind of banking blowout in the US, which for us was never reality or never really a concern. It's obviously something you keep an eye on, but I think mainstream media propped it up quite a bit into this massive collapse of the US banking system, which it really wasn't, but it does kind of cite some risks that one needs to be careful of in the investment world. So a lot of that was causing the volatility throughout March, and you'll see it on the chart there. You'll also see it when those risks start to wash out within days. See markets are fairly quick to continue with their upward trajectory. That was then met with another banking crisis in Switzerland with the collapse of Credit Suisse. Credit Suisse is a big global banking powerhouse that's been around for about 150 years. Again, it would be very easy to draw the conclusion that the SVB failing was the same reason why Credit Suisse failed. And I think it's important to kind of know that they were completely different reasons. There was absolutely no correlation there whatsoever. Credit Suisse is a bank that we've been working fairly closely with for some time. They've had problems for a while now. This is nothing new. What we saw there was ultimately a crisis of confidence. Their main investors just said, you know what, enough's enough. We can't do this anymore. And again, guys started withdrawing at an aggressive rate. FINMA, which is the global or the Swiss regulatory body, stepped in and they facilitated a deal with UBS. So again, that wasn't balance sheet mismanagement or anything like that. They had been under pressure for some time. They had a hedge fund blow up in their face. I think it was in 2020 or 2021 with the whole Archegos drama. So they've been on the front page of the news for a while now for all the wrong reasons. So we saw that ultimately unfold. And again, that brought with it volatility. But in terms of contagion into the actual banking system, that was fairly muted. So often these things on the day the news breaks, they cause a lot of volatility, share prices are all over the place, and then it starts to normalize and people understand the full story about it, and it kind of washes away fairly quickly. Looking at the US in particular, just some kind of noteworthy comments throughout the month. The Federal Reserve raised interest rates by 25 basis points. Again, they're doing this to combat inflation. Inflation is running wild in the developed markets, much higher than what those reserve banks would like it to be. And to try and combat that, they raise interest rates. And really, the whole investment thesis at the moment is trying to understand what the future holds in terms of raising or cutting interest rates. That's where all the volatility is coming from at the moment. That's where all the speculation is coming from. It's just trying to understand, we call it the dot plot. It's trying to understand what that looks like. When will the last of the interest rates be hiked, and when will they start to cut those interest rates? The ECB, the European Central Bank, also hiked rates by 0.5%, fairly aggressive, but again, they're also trying to combat high levels of inflation. So in that, when the Federal Reserve raised those interest rates, they were very firm in saying that, guys, listen, the inflation fight is far from over. We've got a lot of work that we still need to do. The markets kind of turned around and took that as if the Fed was saying that they were going to start cutting interest rates in the second half of this year, which you sometimes kind of look at how the markets react to news and you scratch your head. But ultimately, guys are saying, you know what, they're going to start cutting interest rates by the second half of this year, which I think we view as incredibly optimistic. I don't think that will be the case. With inflation, one always needs to be careful. You can't cut interest rates too soon. Otherwise, you have this deeply embedded inflation that's incredibly hard to get rid of. So you need to make sure you kind of completely stomp out the fire before you start to decrease rates again. So our guidance, or our thinking rather, is that potentially interest rate cuts, in the first half of next year would be a lot more likely. But ultimately, when you start to see this forecasting and speculating by the markets, it's guys positioning for different outcomes, and they're positioning to be in different styles that will be benefiting from interest rate cuts or hikes. So they're basically taking aggressive bets on where they think interest rates are going to go. So yeah, that was quite noteworthy. That was quite interesting. We saw Brent crude, oil, in other words, come down quite aggressively over March, which again is welcomed, given that petrol and things like that are quite high in terms of adding to inflation. However, I will warn on that throughout April, the opposite happened. We saw oil shoot back up again. OPEC and the Saudis have cut back on the supply of oil, which caused oil prices to spike a bit. So that does pose a bit of a forward-looking risk in terms of inflation, because obviously we want to see oil nice and low and those inflation numbers wash out as soon as possible. So as soon as that goes up, it poses a bit of a risk. In the US, we have seen an incredibly resilient and strong labor force. So people in the US, they still have their jobs, they're still earning well, which is a bit of a double-edged sword in the sense that it's obviously good for the US economy and it keeps guys spending. However, for inflation, it's bad because the US consumer has money in their pocket. They're able to spend, and that ultimately drives up inflation. So that's something that we're keeping on our radar. We're watching it we're watching it closely. We have seen hourly earnings, which is a nice gauge for what wages are doing. We have seen that look as if it's peaked. So hopefully we'll start to see that trickle down in the coming weeks and months, which will be, again, good for inflation, good for any interest rate kind of forecasts. Rent in the US, again, also coming under a bit of pressure, which is good for inflation. Rent is a very high component of core inflation, so you want to see rent coming down. Again, not so great for the landlord, but in terms of the double-edged sword for inflation, it is typically quite good. So we're starting to see a peak in that as well, which is good. And then just to wrap it up, sorry, I know I'm rambling on a bit here. I'm trying to fit quite a bit of commentary into a short period of time. China, our big emerging market, our key driver of the EMs, they are on the opposite trajectory. So they're actually struggling with low disinflationary type environment, and they ended up cutting interest rates by 25 basis points, and that's really on the back of them being in lockdowns for so long. So they're trying to spur growth in their economy, which is typically good for the rest of the world, because if you kind of cast your mind back to last year, the whole reason why, or a significant portion of why we got into this inflation mess, is because China completely shut down their supply to the rest of the world. So you had a lot of pent-up demand, but there was just no supply because all of the factories in China were closed due to lockdown. So it's good to see China coming back online. It seems like they've completely abandoned their zero COVID policy. So guys are back at work. They're in the factory. They're making the goods that can be supplied to the rest of the world. So there are definitely some positives there. I'm sure this will come as a question, but looking forward, what are we seeing? So again, we've said it before, a focus on quality. You want to be buying businesses at the moment that have strong balance sheets. They're able to weather the storm. If they've got a dividend component to them, it's always valuable, because if times get really tough, they can cut back on that dividend, and they don't have to borrow extra money at much higher interest rates. So quality businesses are always a good bet in this kind of environment. We've got inflation data out this evening from the US, which is going to be very important, and it's going to kind of tell us and guide us towards the next steps and potentially what the Federal Reserve is going to do. And then I said it earlier, we're keeping an eye on oil just to make sure that comes under control and doesn't push up to ridiculous levels. I think that's quite important. Yeah, I think that just about covers it. It was actually quite a fairly busy month, in that sense. It wasn't just another month. I think the banking, I wouldn't call it a crisis because it wasn't really a crisis at the end of the day, but the whole banking turmoil did create some talking points and some volatility. So yeah, that's where we are.
Thanks very much, Anthony. I wanted to ask you, well, two things. One is, when that inflation data comes out tonight, why don't you just ping me like a short message that I can post on the group, so that you can give us your 10-second synopsis on what it is. And then the other thing I wanted to share and ask you was, this was an article that I got sent over the weekend, and it was really talking about the power of the BRICS nations and how they're sort of becoming more economically powerful than, you know, the old traditional G7, etc. And ironically, I actually had a client this morning phone me and say, you know, they're really worried about the US dollar and should they be investing in, you know, in America full stop because of the dollar, etc. What's kind of your take on, because there's a whole bunch of things that happened. And just by the way, if anyone in the mastermind is not in the Wealth Hackers, you know, please make sure you sign up to that group, because that's where I share that information. But it's, you know, it's a whole bunch of, it's interesting because you just said, Anthony, a whole bunch of significant things happened in the banking world, but actually a bunch of other things also happened, you know, as this almost shift to the BRICS away, you know, certainly the BRICS wanting to compete with the G7, if you call it that.
Yeah, definitely. I think in terms of it's such an incredibly challenging argument, or to kind of put your finger on it and be right or wrong. I think everyone's got their own points, and they're incredibly valid. And yeah, I mean, for me, look, I mean, most of the transactions in the world are done in dollars, and it's the way it's the way it is, and it's the way it has been. So to kind of reverse that and backtrack that is going to be incredibly challenging. I don't think it's impossible. I don't think it'll happen overnight either. But I think for now, if I was looking at, let's say, the currency pair US dollar euros, for argument's sake, I think just by looking at the DXY index, which is essentially your US dollar index, you'll see that the dollar at the moment is incredibly strong. And if I were playing currencies, I would say to myself, you know what, the dollar is too strong. It needs to kind of come off its high horse, which it slowly is doing. And I would potentially be using my dollars to buy GBP or euro or Swiss francs or something like that. In terms of the world order changing and a different currency coming into the equation, sure, I don't have much to say there. I'll be deadly honest with you. I think it's quite speculative at the moment. People have got their ideas of different currencies and cryptocurrencies coming to play and things like that, which it could potentially happen. But if I were to take it on a pure investment thesis and look at the strength of the US dollar as it is today, incredibly overvalued and definitely needs to come down from its high horse. Yeah.
Perfect, thank you. Any other questions from anyone in terms of the whole intention was, and just from my perspective, thank you very much, Anthony, because you gave me better perspective of what happened with Credit Suisse and Silicon and whatever, without having to go and spend hours and hours and hours reading all about it. So I appreciate that. But any other questions from anyone in terms of the kind of the market update for the month? Either chat or type them in the chat.
Can I ask verbally?
Yeah, go on, yeah.
Yeah, how's it? So I guess, obviously this whole thing around the bank crisis, as you're saying, kind of it's happened, hasn't happened, like all of that, and what should we be thinking about it? I mean, with the Fed, and I think it's the FDIC and all of that, and this kind of idea that everything is going to be centralized towards the too big to fail kind of banks. And then maybe, and not kind of getting too close to conspiracy, but like the whole drive towards central bank digital currencies and the overall like strength of the banks. And I mean, are they not just essentially kicking the can down the road in terms of passing on the debt? And what does the overall banking picture look like for the the next 5 to 10 year view? And obviously, I guess the US being the bigger component of this, and then possibly having an impact on the rest of the global banks outside of the US. So yeah, just some general comments around that, please.
Yeah, sure. I think the central bank digital currencies, I think, is fairly imminent in the sense that they're testing them and they're looking to kind of trail them and see how it's going. So in that sense, I think you will start to see developments on that front. Again, how quickly and how rapidly one can adopt a system like that is yet to be seen. And I think that's where the challenges will come in. But I think it's very much on the mindset of central bankers around the world. And we've seen that. We've seen guys taking it to trial. I don't remember the exact countries, but I know there are a few. I think South Africa is actually one of them at the moment as well. So in that sense, yes, I think that could be very likely. How that will be governed and controlled is yet to be seen. But I would imagine that the central banks will have all the power there. So again, whether you're taking that power away and giving it to the people, I highly doubt it. They're always going to make sure that they've ultimately got control. In terms of the banking sector and the strength, in particular the US, the guidance that we've been given is that the rest of the banking sector is sound and it's strong. Now, with that, you're reliant on what the Federal Reserve is telling you, which is not you either kind of take it for what it is, or you take it with a pinch of salt. If you start to do some kind of analysis on the bigger banks, and the reason why I say bigger banks is because it's unfair to compare Silicon Valley against Citibank or JP Morgan, or something like that. They're completely different banks. I mean, one's regional, one is, I mean, these are massive banks. So to draw those kind of comparisons, I think, is unfair. The Citibanks and the JP Morgan, the big four, have really proven that they can manage their balance sheet, and they can manage the risk. So I think when you break down their balance sheet and you see how much long-term government bonds they hold versus what Silicon Valley Bank held, you can see there that they've got much better controls and measures in place to manage those risks. I think I even read about Silicon Valley Bank that their chief risk officer stepped down last year, October, or something ludicrous like that, and he wasn't around for a couple of months, which you'll never see something like that happening in a JP Morgan, things like that. So I think the banking sector is strong in the US amongst the big banks, and I think they're fine. I don't think there's reason for concern there. What I do think will come out of this is I think you'll see a clampdown from government on a lot of the regulations that goes into these smaller banks. So I think the watchdog will have a much closer eye and a much closer dealing with them going forward. I don't think they're going to just say, you know what, this was a one-off, one or two banks collapsed. Oh, well, let's move forward. So I think you're going to see a massive uptick in regulation. And I think that's going to overall contribute to a safer, more sound banking system in the US. Yeah.
Thank you.
I didn't think you could have more uptick in regulation from 2008, 2009.
Yeah.
The American banks are already ridiculous.
Yeah, no, agreed. But I really think that's where you'll see a lot of the change coming in. And I mean, if those allegations or those rumors around not having a chief risk officer present for a couple of months, I mean, geez, that for me is ludicrous. So I think that's where you'll see a lot of the regulatory clampdown from the government come in. And
perfect. Any other questions? I'm conscious of your time, Anthony. I asked for half an hour. I'm way over time. So,
no
but,
stress.
is there anything else from anyone else that people want to kind of get an update? I do want to say that Anthony and Alex are also talking and just ironing out so that we can actually help with people to be able to invest directly with regards to some of the Calio deals, etc. So that's a work in progress that is coming in terms of that process, because like we said, in terms of diversification, we want to be working with Calio and getting access to Calio deals. And then we have had meetings also about trying to get all the Calio deals onto the Wealth Migrate platform. And it's a work in progress. It's unfortunately quite painful in terms of jumping through those steps. But ideally, with time in the near future, we'll actually be able to not only get access to what I'm going to call off-market deals, but then also access to Calio deals, but on the platform, if that makes sense. So I just, and the whole idea with this analysis, and tell me if I'm wrong, Anthony, from your perspective, but it's just a general overview so that all of us on a monthly basis can just have an understanding of what's going on in the world, geographically, politically, economically, etc.
Yeah, 100%.
Awesome. Any closing comments in terms of your thoughts for the month ahead?
No, look, I think we kind of rung the bell early this year to start making any idle cash making its way into market. I still think that's the right call. We said that the year is going to be volatile, which it is going to be volatile. Q1 earnings season starts to kick off now, so you'll see a lot of the big US guys starting to report their earnings. There is a global slowdown. We know this. You can't have lockdowns and things like that, and it doesn't ever come home to roost. So I think we will start to see a bit of a earnings crunch. But again, quality businesses, strong balance sheets will be able to weather the storm far better than those that are highly leveraged, unprofitable businesses. So focus on quality and expect some volatility.
Awesome. Well, thank you very much, Anthony. I don't know if there's anything else or if anyone else has any other questions. Otherwise, we'll pivot to the final part of today. I am conscious of the fact that from a timing perspective, I'm not quite sure how to manage this. I have to kind of think it through in my own head, because the last thing I want to do is kind of stop Bruce and Sharon or any one of the industry partners in their stead, because we're learning a lot. And equally with you, Anthony, I don't want to stop people in their stead, but I'm also conscious of the fact that we over time by 20 minutes already. So I'm gonna have to try and figure this one out, you know. Sorry, Derek.
Scott, can I ask Anthony just a quick one? Anthony, we talk about slowdown. Is that not recession in disguise?
No, I think recession is quarter-on-quarter GDP contraction. We need to slowing down is potentially only buying one good as opposed to two, and not being overly zealous when it comes to you being a consumer. So I think there's a big difference between being sparing with your money and actually not having money to spend. So I think there is a difference. I think recession, yeah, I mean, the word recession just tends to spook people and spook markets. But ultimately, there's going to be a global slowdown, not necessarily a complete wheels falling off the wagon, and an all-out recession. I think it's very important that those words are differentiated. Because I mean, recession, you would kind of sit on the sideline and say, you know what, I'm not investing. S&P is dropping another 25%. Whereas the reality in a slowdown is that if you've still got exposure to quality, good businesses, you can still generate some attractive returns.
Thank you.
Awesome. Anything else from anyone? No. Anthony, deeply appreciated, mate. Thank you very much. As I said, there's a number of people you didn't actually hear because you weren't here right at the beginning. The number of people who couldn't make today that have asked for the recording, so I will be sharing it with them. But yeah, really appreciate your synopsis. And if you don't mind sharing the slides, I can share those with people on the group as well.
Excellent, will do. Cheers, Scott. Cheers, guys.
Let me know about that inflation thing tonight. I'll rely on your intake, your input.
I will do.
Awesome.
Cheers.
Thanks, Anthony.